Dozens of small banks in Kenya are feeling the pinch of a funding crunch as interest rates surge, impacting the cost of borrowing in the interbank market. Owing to this, Tier 3 banks have increasingly sought assistance from the Central Bank of Kenya through tools like reverse repurchase agreements and term auction deposits. This move comes in the wake of dried-up funding conditions in the money market, largely attributed to escalating government payments, causing banks to fall short of cash reserve requirements. Interbank lending rates have soared, putting smaller banks in a tough spot. Now, the CBK has stepped in, facilitating the trading of repurchase agreements to redistribute liquidity across the sector. Struggling to borrow funds within the sector, smaller banks have found CBK to be their lender of the last resort. Now, analysts predict that smaller lenders will continue to face challenges in this tightening funding environment, and the liquidity squeeze has also affected securities trading, with the new CSD platform gaining traction. And despite these hurdles, CBK maintains that the banking sector maintains overall stability with a strong liquidity. In the face of these developments, the banking industry is poised for a period of recalibration, navigating the complexities of an evolving interest rate landscape. So joining me from Nairobi, Kenya, I have Professor Iraki, Associate Professor of Economics, Kenya. Thank you so much, Professor, for joining us.
Hello, good afternoon or good morning, wherever you are.
All right, nice to have you with us. Now, let's first get an overview of Kenya's banking sector money markets.
I think that the issue that has been raised about banking crisis, but not crisis, but liquidity crisis, is not very unexpected, but it's not as big as expected. So what has happened is that in the last 1 or 2 months, the central bank has raised the interest rates. So that means it has become a bit hard for people to borrow money. And that probably has contributed partly to the liquidity crisis. Remember that we are still suffering from the effect of COVID-19 when the economy was not doing very well. We also have had the problem of Ukraine. So looking at those internal problems and external crises, that's probably the reason why the banks have not done as well as expected. But there's only 1 or 2 banks whose names have not been disclosed. So I don't think there's any cause for alarm. The market will set itself back.
COVID-19, we've seen other African economies that have stepped past this stage, and they're not grappling with this particular issue at this time. Why is it a cause for concern? You have said that it's not a cause for concern, but then why is it that the Kenyan financial sector is going through this particular phase when other economies have actually escalated?
Traditionally, banks in Kenya have performed very well. In fact, they are some of the most profitable sectors of the economy. To make it even more lucrative, if you want to really buy shares that will give you assured dividends in Kenya, those has been the main shares or the main stocks that people are focused on. But because of the confluence of those internal and external forces, that's why they have not performed as expected. I've talked about non-performing loans. I've talked about the effect of COVID so that the economy has not grown as fast as expected. We have talked about what has been happening across the seas, like the US government increased the interest rates, so that people have been moving money that way, and that has affected the exchange rate of this country. So I think it is a confluence of those 2 ideas, of those 2 issues, that have made the banks not perform as much as expected. But as I said earlier, it's only a few banks. Most of the banks have been performing very well, giving very good dividends, and recording record profits.
All right, so now we see a situation where dozens of small banks are finding themselves in a funding squeeze. That's according to the report anyway, owing to the sharp rise in interest rates. This has also affected the cost of funds in the interbank market. So what could be the impact on the banking sector, looking at it generally now?
I see two main trends that might take place because of that. I can see the small banks being squeezed to merge together so that they have better liquidity and they can perform better in the market. In fact, there is a past we have seen quite a number of banks in Kenya merging together. There's also a question, there's also a possibility that some of them might be bought out. We have had a few banks being bought by some external banks to become more capitalized. So it might shake up the competitive landscape of the Kenyan banks by having bigger banks, which probably be more competitive, they compete with each other. But we are yet to see the effect playing it out in full.
So then what about the tier 3 banks who are said to increasingly be turning to the Central Bank of Kenya for funding support via reverse repos, term auction deposits, and of course CBK discount window? How effective have these tools been in addressing the funding squeeze?
Yeah, it's interesting that the banks are using some tools that have not been used in the past. So the repos and so on have not been very common in the bank. But because of that small problem of liquidity crisis, then the banks have to use new tools. And the government has been encouraging them to use such tools like repos, borrowing to each other overnight before going to the central bank. And that has made the banks more liquid and more competitive. So I think the use of these new tools, repos and so on, is probably temporary. It will go back to the usual ways of operating, and then the problem of liquidity will be sorted.
All right. Well, according to the data from the CBK, funding conditions in the money markets were said to have dried up in recent weeks, with banks, for instance, failing to meet their cash reserve requirement ratio at 4.25% over the past 3 weeks anyway, till about August 3. Even commercial banks' reserves stood at a shortfall of 4.7 billion shillings in relation to the CRR requirements last week, marking a third straight week of reduced liquidity in the banking sector and money market. So if you had to look at it holistically, how dire is the situation? Is this a cause for concern, which of course negates what you said earlier?
I think if you look at the history of central bank all over the world, what the Central Bank of Kenya is doing is what it's expected to do. It's supposed to be the red of the last resort. It's supposed to make sure that banks are liquid, banks don't have a run, banks don't have problems, and the central bank is doing its work. But I believe that the owners of the banks that have a liquidity crisis are doing something about it. They are borrowing money from each other overnight and otherwise. And I believe in the long term, the problem is going to be solved. Remember, we have had some banks failing in this country in the last few years. I don't think the central bank, I don't think the bankers themselves, anybody would like that to happen, particularly when we are in the middle of what is happening globally and what is happening internally. So I think the central bank and the bankers themselves are taking appropriate measures to make sure that no bank collapses, no bank gets into problems.
All right, then with the interbank lending rate at an 8-year high, could you actually just explain the reasons behind the recent spike and the implication it might have on the banking sector too?
The interbanking rate is under the rules of supply and demand. If more banks are borrowing from each other, the rates go up. And it's more so when
Go ahead,
sorry,
Professor.
somebody trying to interfere with by calling me through. But I was saying that just go to the question again, please.
Yes, I actually asked that with the interbank lending rate at an 8-year high, I'd like you to just explain what implication it will have on the banking sector and why we are still seeing a recent spike as regards that.
I was saying that the interbanking lending rate, the interbanking lending market is under the rules of supply and demand. If there are more banks that are trying to borrow from each other, the market rate or the interest rates go up. So it's just the normal rules of economics that there are more banks who want to borrow from each other because we don't have as much liquidity as possible. But we are seeing the central bank coming in to make sure there's enough crisis and banks operate and serve their role as intermediation in the economy.
All right, Professor, let's look at it this way. Looking at the horizontal trading or repurchase agreements within the banking industry, what impact would that have on the liquidity distribution within the sector?
Yeah, it's interesting because if we don't have liquidity, then the banks are not able to lend as much as expected. So we expect the banks not to be as vibrant as expected. Because if a bank is having a liquidity crisis, they are not going to start lending money to the other people or mostly to the people who want to borrow money either for investment or money for consumption. So there will be a reduction in the borrowing, and that will have an implication on the supply and demand of goods and services in the economy. The only positive part of that is that if banks are not lending as much as expected, then there's a positive effect on inflation. Inflation reduces. And one of the reasons why the Central Bank of Kenya has been raising the interest rates is to try and reduce inflation. But that has been counterproductive on the other side, because when interests go up, then there is more non-performing loans, and less people borrow money, and there's less investment, and that can lead to less jobs being created.
So does that mean that the banks should not go to the CPK to seek some bit of reprieve or some sort of support from them? Is that what you mean?
And that's not what I meant, because at the end of the day, the banks always portray the economic situation of a country. The more solid the banks are, the more confidence we have in the banks, the more confidence we have in the economy. So I think they are going to the central bank, they are borrowing from each other to make sure there's liquidity, there's stability, and banks serve their main purpose as being the heartbeat of the economy.
All right, Professor, still talking about liquidity. The policy securities rollover due to the transition to the DOE CSD platform was said to have led to increased demand in the interbank markets. Now, how has this affected liquidity needs and market dynamics? From your own opinion, anyway, the way you see it.
I think the new system by the central bank in the last budget, the central bank said they are going to come up with a new system, how the banks are going to interact with each other, with a unique name called DAO, CDS, and DAO has always been a boat that has been trading on the Kenyan coast for a long time. So I think that's a technological issue. Before it is smoothened out, before it becomes very operational, we expect such teething problems. But I am sure with the time, they are going to be sorted.
All right. Now, okay, the CBK stated that the banking sector remains stable and resilient with strong liquidity and capital adequacy ratios. Do you also share that sentiment based on the readings? And how do you think these metrics would contribute to the sector's overall health and stability?
The most important thing we expect from central bank is to assure the borrowers and the lenders in this country that the banking system is stable. They must build confidence in all the players in the banking sector. And I think the central banks should follow that assurance by making sure that any bank that has liquidity crisis is taken care of. Any bank that has a problem with liquidity does not have any problem that is going to be systematic to the other banks. The central bank should make sure that the problem with a few banks is not systematic and does not affect the whole banking sector. And that's the work of the central bank. And we expect the central bank to act as much.
All right, finally, Professor, looking forward now, what are the potential strategies that you think can help our smaller lender what you feel that small lenders can actually do to address ongoing funding constraints that they might be faced with in the face of rising interest rates and the environment that might not be too conducive for them now?
I think in the long run, what our banks must do is to get higher capitalization. I know the central banks one time was pushing banks to have high capitalization, so they can get more capitalization. And some of them can also merge. If two banks merge, they become bigger, they'll be more liquid, they'll be more capitalized, they'll be able to deal with competition. So those are some of the things that banks can do in the short run, because some of the factors that are affecting liquidity are external and beyond the bank's controls.
All right, Professor Iraki, thank you so much for joining us.
Thank you and have a good afternoon.